It's 1997, and Jerry Yang, one of the founders of mega-successful Yahoo.com, is touring China. The US-based company has recently had a smashing success in Japan, launching the country's first web portal thanks to support from legendary investor Masayoshi Son, and is trying to develop a China strategy. At the time, China had only a few million citizens who were online, but it was obvious that this was about to change. Yang talked about this with his government-assigned handler. The former English teacher and the failed entrepreneur was more than happy to discuss the internet with a pioneer like Yang and hoped to learn about how it might shape the future. It was an impossibly lucky meeting for both men, because that handler was Jack Ma, and 2 years later, he would go on to found Alibaba, which is now the most valuable company in China. American companies had, and continue to have, significant issues when they try to expand their reach into China, and Yahoo was no different. After Yang's trip to China, the first strategy they settled on was to launch a product similar to what they'd done in Japan. Yahoo China was up and running in 1999 as a platform for email and messaging that also provided access to 20,000 websites and translated the company's US news content into Chinese. They didn't find nearly the success they had in Japan, though, and were getting soundly beaten by Chinese competitors. So instead, they pivoted toward buying a local company to help them. In 2003, they purchased 3721, basically a Chinese web browser company, but again, there were issues. Yahoo tried to impose U.S. reporting and governance standards on their acquisition, whose leadership didn't appreciate that and also considered members of the existing Yahoo team to be lazy and not good workers. So, 2 strategies have failed, and now it's 2005. Silicon Valley is hosting a big event to bring Chinese entrepreneurs and executives stateside. The star of the event, by far, is Robert Li, CEO of Baidu, the leading search engine in China. Jerry Yang was in attendance, hoping to speak with Li about possible partnerships in China, and Jack Ma flew in, hoping to speak with Li about funding. Things ended up working out like a romantic comedy. They both struck out with Li, but they found each other instead. Yahoo had plenty of cash to invest in Alibaba, and Alibaba was emerging as one of the most promising e-commerce sites in the country. They also had one important thing in common. Just as Masayoshi Son had been a very early investor in Yahoo, he had taken a large stake in Alibaba in 1999. Now, it looked like his original investment had grown to be his partner in Alibaba, which is exactly what happened. For $1 billion plus the remaining assets of Yahoo China, Yahoo purchased 40% of Alibaba. Masayoshi Son would own 30%, and existing management would own the rest. The investment came at the perfect time for both sides. For Alibaba, at the time, one of their main properties was an auction site, Taobao, which was going up against a competitor called EachNet that had partnered with eBay. The $1 billion allowed them a cushion to survive on while undercutting EachNet, which simultaneously was experiencing the culture clash problems with eBay that Yahoo had faced with its 3721 acquisition. Eventually, consumers chose Taobao, who had a dominant position in the market just 2 years later. For Yahoo, the investment was timely because it was becoming clear that Google was going to be the number 1 search provider in America. So just when it seemed that Yahoo was entering an inexorable decline, suddenly they had a hot asset. But maybe it was too hot. In my previous video on Yahoo's biggest misses, the link to that is in the description, I talk about how Microsoft made an offer to buy Yahoo in 2008. The offer was for almost 10 times more than the company would eventually be purchased for in 2016, but one big difference is that in 2016, that buyout didn't include the Alibaba position. In Yang's letters to employees about turning down the Microsoft offer, he wrote, "We believe Microsoft's proposal substantially undervalues Yahoo, including our highly recognizable global brand, large worldwide audience, significant recent investments in advertising platforms, future growth prospects, our ability to generate free cash flow, and our earnings potential, as well as substantial unconsolidated investments like Alibaba and Yahoo Japan." They're the last thing he mentions and only make it in via parentheses, but Yang seems to understand what's coming. Unfortunately, a lot of people did not, and as a result, shareholders went ballistic when Yahoo turned down Microsoft's offer, which had been for a massive 62% premium over where shares had been trading before the offer was made. This first led to Yang being removed from his CEO position, and later, and even worse, in Yahoo selling off half of its Alibaba position for cash despite his protestations. They received $7 billion at a price of $13 per share. That's a 14x return, selling half of $1 billion investment for $7, but by the time Alibaba was ready for its US IPO just a few years later, those shares would have been worth about $50 billion. And of course today, summer of 2021, shares are trading in the low 200s and had peaked previously at over 300. An optimist might say, well, at least they didn't sell the other half, but that depends on what they're being optimistic about. Here's the problem. Yahoo, the company, was in decline. Google built an unassailable lead in search. They didn't offer enough for Facebook when they had the chance to get into social early, and when they did, they bought Tumblr, whose fall was happening even quicker than their own. The decline was so dramatic that Yahoo's actual operations didn't really matter to the stock price anymore. That tracked Alibaba, sort of like how Microvision, who's pumped its balance sheet full of Bitcoin, tracks that asset today. All of that meant that although owning a large Alibaba stake had propped up the stock price, Yahoo was effectively dead as an independent company. The most important thing in the world to Yahoo shareholders was figuring out how to get value from the Alibaba stake while incurring as little taxes as possible. This situation actually led to the implied value of Yahoo to be less than zero. Here's how one analyst described it. The whole point of Yahoo as a company right now is not to pay taxes on Alibaba. Those Alibaba taxes are worth at least 2.5 times the value of Yahoo's entire business. If there were a way to avoid paying taxes on the Alibaba shares that involved burning all of Yahoo's actual businesses to the ground, Yahoo should do that. The initial plan was to spin off the Alibaba shares to Yahoo shareholders, but the IRS said that would be a taxable event, and that's why they ended up having to do the opposite. Instead of selling their Alibaba stake, Yahoo had to sell their Yahoo stake. That's where Verizon comes in, scooping up Yahoo so the Alibaba assets could remain held by the Yahoo shareholders in a new entity called Alibaba, which eventually liquidated the holdings and paid out shareholders in 2019. Jerry Yang's Alibaba investment is one of Silicon Valley's most legendary tales, yet its legacy is a little more complicated when viewed from a broader perspective. It led to what was described as the saddest $5 billion deal in history. Jerry Yang founded Yahoo. Then he saved it by investing in Alibaba. Then that investment got him ousted as CEO. And then that investment killed the business he had founded. Capitalism is a brutal sport. Thanks for watching, guys.